Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. Today's guest is, of course, based out of Florida's high growth markets, and he's focused on build to rent revolution. So, of course, we are going to talk about that. His name is Jim Sheils. Jim is a partner at Southern Impression Homes, a company that specializes in building rental portfolio for individual investors like us, and of course, institutional buyers. These homes provide new construction, low-density properties such as single-family homes, duplexes, and quads with property management in place. Jim's experience in real estate investment extends beyond his partnership with Southern Impression Homes. He has done over 2,000 rehabs and formerly owned Jax Wealth Investments. So welcome, Jim.
Hey, thanks for having me. Good to be here.
Absolutely. So, Jim, we start with this question with all the guests. Tell us something interesting or funny about yourself.
Interesting or funny about myself. I have 5 kids, which they makes me insane. And I don't like mayonnaise. I can't stand mayonnaise. Give me anything but mayonnaise, but I'm not a mayonnaise.
So I think the 5 kids, I would just stop there. That's interesting as well as funny. It's hard. It's hard for, with 2, I'm struggling. So I know how it would be for you. So let's talk about investment side, because you have done so many rehabs. You have been in the industry for a while. What was your first investment?
My very first investment was a 3-family house in Lompoc, California, so just a few hours south of you.
Okay.
In the late 90s. Yep.
Wow.
Getting the call from my agent, $152,000.
Of course.
For a 3-family house, and I was hyperventilating in the kitchen because I thought, wow, this is a big commitment. So that's where it all started 24 years ago.
At that time, that 150,000, it's worth way more, at least 10, 20 times right now. So
it's huge. Yeah.
And how did it work out for you?
On my first property, I hit a home run. That property, I did the classic, bought it, fixed it up, raised the rents, kept it, managed it, and then refied off, put it into more properties, and it did very well for me. I finally sold it when I was making my move from California to Florida, so it was kind of like a piggy bank to me. Now, my second, third, and fourth deal didn't go so well, but my first one was a home run.
Yeah, and that is very important that you pointed that out, right? People need to know you can't have home runs every time.
No.
You got to be, ready to tackle issues. And right now, especially, I'm going through a lot of issues on my deals right now. And, that is expected, right? You can't have home runs every time. And you don't want to look for blockbuster deals every time.
Yeah. And the good news is normally one deal won't ruin you. Especially if you stay in the game and you keep progressing forward. The old baseball analogy, hitting singles and doubles, and you might have counts. But what I've found is I was able to more fine-tune my investment strategy. And had I not made those mistakes early on, that would have probably not made me as knowledgeable on the market as I am today.
Right. Yeah. No. Yeah, you got to learn from your mistakes. Every deal is a seminar, right? You learn and you move on, right? And you apply that knowledge to the next deal.
Yeah, absolutely.
So let's talk about this revolution, right? Dump it down for us. What is build to rent?
Yeah, build to rent came out of necessity. I was always a rehabber. That's where I made my bones. I went into this game 24 years ago, and really my whole niche to wealth was I knew how to find an old fixer-upper and fix it up and either rent it or sell it. That's it. That's all I knew how to do. And when I left California in 2005 and came to Florida for better fundamentals, that's what I continued to do. And then after 2008, man, it got really good to find fixer-uppers and fix them up, rent them out. But by about 2014-ish, the market started to get saturated with a lot of investors looking to do what we were doing. And me and my now building partner said, what if we could build our own rentals instead of find old fixer-uppers? And those were our only choices. And so build to rent is basically building properties, normally low density, at least in our case, single family duplexes and quads, specifically designed for investors, either ourselves or clients we work with, for long-term rentals. These houses are in the condition that you could sell them retail, and we do have retail buyers, but we like to work with investors. Our whole investor system is, we say, created by investors for investors, because again, my building partner and I, we were doing, bulk foreclosures, hundreds of properties a year before we switched to construction. But we found with the new construction, Alpesh, there was some real advantages. One of the biggest things was the 3-year curse went away. And I don't know if you've heard of the 3-year curse, but we bought a lot of houses from the 40s and 50s, and I'd fix them up. There'd be a new roof, heating and cooling, plumbing, update kitchens, baths. I mean, everything. Right. And some reason, and I own a lot, so I'm not knocking them. They can be a great wealth strategy for homes. After 3 years, I need to up my budgets for maintenance and repairs. The turnovers, maintenance.
Yeah, I know. I've been through that too.
You've been through it. So I'll tell you, almost a decade in on this new construction and doing over 2,000 properties now, we haven't seen that 3-year curse hit. And I think it's because you're able to build the property, first of all, in better areas. Second of all, you're able to really start from scratch.
Yeah, so they got good bones.
Yeah, that's a huge difference. And I think for a lot of investors too, when you get a property with some deferred maintenance, or it's a fixer-upper, you either think you fix everything, or you say, you know what, that's not that important to the safety of the tenant right now, or to getting the most rent. I'll just wait on that. Man, and that bill comes due a lot quicker than you think it's going to need to. So deferred maintenance comes at the worst times and at a bigger price than when we thought. And so the build to rent helps take all that out of the way. Build to rent, again, gets you into new construction and allows you to look long-term with less headaches, less maintenance and repairs, less turnover, better areas, better resaleability and overall rental growth. And that's what we're all looking for. At least I was always looking for with my rental strategies and my overall real estate wealth.
Got it. No, that makes totally sense. And I'm seeing that. And of course, I'm sure you follow John Burns as well, right? He speaks a lot about build to rent, right?
I had a call with John a couple of weeks ago, me and my partner.
He's amazing. Yeah, I read his book and I'm like, this makes so much sense.
John, we really appreciate all the nice things you're saying about us. It's not you guys, to be fair. It's just I like what you're doing and where you're doing it. We're focused in Florida. We're in over a dozen markets in Florida. We started in Jacksonville, which is our core market. But we could see also with the build to rent, we're able to scale a lot better and a lot healthier than trying to find old fixer-uppers, because those are always a guessing game. But now we've been able to go into over a dozen markets, with a bunch of different property diversity, which is great, not only for us, but for our clients.
So I have some questions about that. And that was one of my questions, that which markets. So can you elaborate? You mentioned Florida, but why those markets? And
yeah, when I first went into this game years ago, I had a mentor, and he taught me, he said, look, don't depend on appreciation, Alpesh, but
I agree.
But if you can do your best to get in its way, there's nothing wrong with that.
Yep.
And I always like that. So you start with a base of cash flow, but try to get in the way of growth. And there were 5 factors to growth: population growth, economic growth, a good affordability index. This is the big one, because this takes San Francisco and other markets out, where that means the average salary of a household income can afford the average price of a home. That's a really important thing. What is the affordability index for your area? And then also desirability is something drawing them to the area, and obviously healthy supply and demand levels. You want to go where an area where they don't have enough housing, not too much housing. And so Florida was a perfect spot for all those reasons. The pandemic just opened up an even greater growth train that was already occurring. We were already having a lot of baby boomer migration here, but the pandemic opened up a whole younger generation moving here. And also, I'm sure you saw in a lot of areas, it got unpredictable about landlord-tenant laws.
Oh, yes.
There's a lot of different treatments in different states, and we really wanted to be a place where we could collect our rent and our clients' rents. And so Florida has been a really strong go for us. And we figured instead of going to other states, we were in Georgia for a while. We don't build in Georgia anymore because, again, we don't like the landlord laws. But landlord laws are something we really look for. But that's a big reason, Alpesh, why we came to Florida.
Got it. But why this particular markets? And do you think this build to rent revolution will be sustained? Because how many renters can you find?
Well, that's a great question. Well, first of all, why these markets? So those 5 factors, every market we go into, from the Jacksonvilles to Palm Coast to Ocala to several in Southwest Florida, we look for those 5 factors. Is there population growth? Is there economic growth? What's the affordability index look like? Is there desirability? Is there something drawing them to the area? And what are the supply and demand levels? Like, for example, Southwest Florida, which was the fastest growing area in the country during the pandemic. Well, we got a report in 2019, so even before the pandemic started, and they were 3 years behind on needed rental inventory then, before that huge growth occurred even. So that's why we go to areas. We want that healthy supply and demand as builders. I would hate to go to a small Midwest town that was based around one industry and that industry had closed down and there's more in our jobs. So we really look at those levels. And I do think it's sustainable. And one of the reasons is we're still behind on needed inventory. There's not enough housing inventory. And even since 2008, I talk about this in some of my presentations, 2008 did some crazy things to real estate. And a lot of the builders only look for larger margin builds, meaning that they're not building smaller properties, properties under 1,200 square feet, I think, or under 1,300 square feet, it's less than 10% of the build right now. So that means that these smaller starter homes are smaller units like duplexes and quads, which the national builders don't build basically any of those. They don't build duplex, they don't build quads. We saw in the market, and we're still at a very, very high occupancy, and that's still continuing to grow.
Got it. So my other question, and of course, as I mentioned, I read John Burns as well. And you mentioned about affordability index. If that area is affordable, why would people not end up buying at some point?
I think that's a personal choice and a mindset. I have, even with me, I have a large family and some nieces and nephews. And some of my nieces and nephews are saving, and they're going to own their first home at the age of 20 or 22. Yeah. I have ones closer to 30 that say, oh, I don't want a home. That's a trap. I don't want to be tied down to that. I don't want that. And I think there's a mentality there where people don't feel safe in owning. Some people still remember 2008. They feel safer. No, renting doesn't tie me down. Houses aren't going to, they're not going to make me money. They're going to cost me money. I'd rather be someone else's issue and problem. So it's just a different mindset. And I can't tell you exactly why, but I've even seen people close to me. Some people, I love owning homes. I always have. That's my tangibility effect. Some people have no interest.
Got it. And what are some of the things investors should look for when they are looking at build to rent properties?
Yeah, well, first off, you want to make sure that the building company that you're going to has a track record. If they've done less than 500 properties, really, they could still get you a great deal, but they're still in ramp up phase. And I can tell you, because those first few hundred that we did, we really had to learn the systems. And now, over 2,000 in, you start to really get into a stride. And you want to make sure, has their system been vetted? Has it been tested? Will they be able to finish the build? That's something they want to look for. They also want to look at the viability, the financial viability of a builder. You hear about builders out there that are having trouble making the bills, and that's obviously not someone you want to put a deposit with. So, what is the viability? I know that our business actually increased a lot over the last 6 months because a piece of our company was acquired by Sumitomo. Sumitomo is the large Japanese company, 330 years old. They build 7,000 homes worldwide. And what happens with us with that is we no longer have banks that loan us money. Our parent company now loans us money. So we have a 330-year-old company backing all of our projects, which gives us a very healthy balance sheet. And I think it's important for investors to ask, what is the financial stability of your building company? If you're going to work with a build-to-rent company, are they stable in their financials? Do they have management in place that's been tested and proven? These are two very important things. And are they building in desirable areas? Because you can build a new construction home in a not so good area. And I just don't think that's the best combination for people to have the best results.
Got it. No, that's awesome. And what should they look for when picking an area or location?
Again, I always go back to my 5 things. Is there population growth? Is there economic growth? Is the affordability index healthy? Is there a desirability there? Is there healthy supply and demand? And kind of the bonus one is, since now, like, because of people like you, Alpesh, getting the word out on different synergies and companies to work with, you're able to look at a national scope.
Yes.
We stay in our own backyard. And I think it's really important to look at landlord laws.
Yes.
Landlord laws are very important. If you can't collect your rent, then it's tough to really, be able to estimate your returns, because that can be a big unknown.
Yes. And that's why I don't invest in California.
I used to be there. I sold my last house in California about 6 years ago.
Right. Perfect timing, man. So let me ask you this. Do you keep owning these properties, or do you sell them to individual investors or a large operator after holding for a certain period?
Yeah, I have my own portfolio. Our company has our own portfolio, obviously. We work with individual investors. Our most successful investors, who are individual investors, usually buy anywhere from 3 to 8 properties, and they see it as a second source of income. They're normally, busy business owners or professionals that want to be involved in real estate, but not, go through all the headaches of building their own team, vetting their own properties, dealing with the awful calls at midnight, and so that's like build to rent for new construction. And we have over 850 active investors, and we also do work with some of the largest institutions out there. Haven Realty, who's owned by JP Morgan, Americans Home for Rent, who I think owns, I forget how many thousands of properties now. We've done many projects with them. So we do work with the institutional buyers. But honestly, Alpesh, my favorite are those 850 plus investors. Right. We've changed their life. They have something to fall back on, either to retire now or retire later, or have a side income, and it's been great to be a part of.
Oh, that's awesome. So, and can you give us an idea on numbers? Let's say if it's a single family, how much is on average price, or maybe for a fourplex, and what kind of rents they are looking at?
So our base price starts around $240,000 for a single family home, and it goes right up to $800,000 for a quad. Our overall returns, you'll see anywhere from a cash on cash return from about 6 to 11%. And that's a cap rate of about 5 to 7% if you do cap rates. So that's on a new construction property. I know a lot of my old friends out there, and I remember that rule of saying, oh, well, we look for the 1% rule.
Right.
And we all know about it. And I used to look for the 1% rule on my older homes. What I've found is my new construction homes, even though they don't perform quite at 1%, perform better, because you cannot discount the lessening of turnover and the lessening of ongoing maintenance and repairs.
Yep.
And that's where you have to look at the two as completely different segments: older properties versus new construction.
Got it. And what's the property management percentage?
Property management fee is 8%. For a lot of the properties that we do right now, Alpesh, we actually waive property management sometime for specials for a year, sometimes 2. We also have in-house financing, which has kind of separated us from the pack a lot, where people were saying, oh, the interest rates have gone up. Well, we're actually now, with being in a healthy position, we're able to pre-buy mortgage rates for people. And so for the last few months, we've locked in several of our clients at 4.75.
Oh, wow.
That's 30-year fixed and a 10-year, 30-year AM, 10-year fixed. So when you start to look at cash flow, and most people are locking in at 7%, that's a big difference. And we feel really good about being able to do that for our clients.
Right. And those rates are what, Fannie, Freddie, or they are out of or they're coming from private?
Yeah, we have a program within Fannie Freddie and one outside of it.
Got it. No, that's great. some of the gotchas, if you can share while doing build to rent.
The gotchas that we experienced were really during the pandemic, and it wasn't just build to rent; it was building in general.
Right.
We were very proud, and you start to wear a little badge of honor on your sleeve that, gosh, we'll finish a house in 6 months. Well, 6 months went to 18 months real quick in the pandemic, because building departments, although Florida stayed pretty open, they were still closed at the building. They were working from home, and materials dried up.
Yeah, exactly. Supply chain.
Yeah, so that was really tough. So what we did for all of our people, and also just like the Nationals, we had to make material price increases, something I had never seen in 25 years, where material costs went up. So we had to go back to our clients and say, here's how much more it will cost. Here's now what the values have gone up to. If that doesn't work for you, then we'll return your deposit with an interest rate. Proud to say most of our people went on, because here in Florida, they could see it was not a profit margin, it was a stability margin thing for us. And you have to have that in your contract. And what happened was the rents and values went up so well in Florida during that it way over superseded, any of that. But those were the gotchas. We've been going along for a few years, doing really well with this. The pandemic hit. We had to learn those lessons. Now we've built through our back inventory, and we're, we can close a new construction property for our investors in less than 60 days, because we're on a continual build. And as they're close to CO, we then release them to be sold. And so people can close very quickly on them to correct ourselves from the pandemic.
Got it. And what are some of the mistakes you have made in this past 20, 30 years?
My big one that I always say, Alpesh, is when I first went into that, it was a race to how many properties you could get.
Right.
Once you got in the 100 house club, you were set. That was it. You had it all figured out. The problem is I got to the 100 house and way beyond, but I broke a lot of my own rules of why deferred maintenance properties and not the best areas, tough to manage.
Right.
And they weren't putting money in my pocket. They were taking money out of my pocket. So my biggest lesson, I think, I always call it what would you tell your brother-in-law if he was getting into real estate? And the joke is, I really like my brother-in-law. So if you don't like your brother-in-law, pretend you do for this advice. And my advice, Alpesh, was always, I would own less of better quality with less leverage.
Right.
That's it. It was, I was so into the numbers and how many I owned. I own a substantially less number of properties than I did years ago, and I have way more equity and way more cash flow than I've ever had.
Got it. No, that's great. What has been your best deal so far?
My best deal so far from if we talk about niches, that first property of 432 North M, that would be probably what I consider my best deal, because that was a big one. When you got to break through that thin paper wall of fear and just sign on the dotted line. I'll never forget that one, because there's so many people I've met that go to the events, they listen to the podcast, and they're just about to do their first deal. And that could have easily been me, 24 years ago, to still be in that mode. And so signing on the dotted line of that one, and the fact that numbers were great on it, that one I remember. And then when it comes to niches, buy, fix, and resell to first-time home buyers, buy, fix, and lease option, wholesale, foreclosures. My best niche by far, Alpesh, and it shows in the numbers and performance, has been the build to rent. This is by far the most evolved model I've ever been a part of, been able to grow, being able to, build up a team where, for doing foreclosures, a small team of 10 to 15 people. Now we have 75 people. Being able to be in 1 or 2 markets, we're now in 14 different markets. And the numbers perform so much better when you can looking at the last 2,000 rehab properties I did compared to the last 2,000 new construction. The numbers speak for themselves. So the best niche would be build to rent.
Well, that's great. And what has been your worst deal?
The worst deal, the worst deal was a combination of properties that I did when I first left the West Coast and came to Jacksonville. And, what I've learned, Alpesh, is whether you might be a senior in a certain market, But you go to another market and you're a freshman again. You got to start all over.
Yes.
You got to build the team. You got to get your bearings. And what I found leaving where I was in Bakersfield, California, and coming to Jacksonville, I thought I knew it all. And that's just not true. It doesn't translate. So I was sold into a lot of properties that break all of my rules today for investing that I don't do. Deferred maintenance in not great areas. And yes, it hit the 1% rule, or it said it did, but these were properties that literally bled me probably for a decade. And I did them without that big lesson that I talked about, where I should have just owned less of better quality and I would have been in much better position. So it was really a collection of properties I bought when I first came to Jacksonville from California. Those were my worst deals by far.
That's great. Thank you so much for sharing all these golden nuggets, Jim. Are you ready for fire round?
Yeah, let's do it.
Would you be changing business or investment strategy because of the current environment, right? Now inflation is slowly going down and we are hearing recession may have passed us already, or still, or maybe around the corner, not sure. So are you planning to change?
We are planning to go deeper into Florida, and we, with our parent company, might be going into Texas.
Got it. And Florida, I mean, so I've been looking at news, right, about all this insurance costs going higher. Is that affecting you or investors?
So again, I have really started to get a mindset on this, Alpesh, of dividing old properties into new properties. In 2004, when Hurricane Charlie hit Punta Gorda, it decimated the area. My dad's cousin lived there. You know, it was really terrible. But the government stepped in and said, no more. You got to change the way that you build. You got to build on higher ground. You got to build with stronger structural materials. And so when you look at this last big hurricane that came through, we had over a couple hundred projects down in Fort Myers and in Punta Gorda, and we did fine. We had 4 properties that needed insurance claims, and that's only because it was just freestanding walls. We hadn't had a chance. Yeah, but no flooding, and no flooding, which is the major damage. So I say property insurance, especially in Southwest Florida, will cost you more. But there is a big difference between a house built at 2 feet above sea level compared to a new construction built at 14 feet above sea level, and what the insurance companies will quote you at, because they're all about risk analysis. And so you can have, even where I live one off the ocean. My house was built in 2004, and I'm on a higher ground. And so you can go into an area, and I'm on a small barrier island, one of the small older homes in here, their insurance will be 12 times more than mine. Wow. On a small home. So you have to look at that. So Florida, yes, because of the hurricane last year, there was some increases, but new construction is a loophole that can get you the best rates for insurance. And in certain areas that are lowest hurricane zones, if that's your concern, Ocala, Inverness, areas like that, a lot of areas of Jacksonville, you'll be pleasantly surprised of what the insurance rates actually are. That's
awesome. Favorite nonfiction book? It could be real estate, investment, business.
Yeah, I'm a big fan of The Alchemist. If you've ever read that.
Oh, yes. Great book, man.
Yeah, The Alchemist is one of my favorites, and for finances, Richest Man in Babylon was a good one.
Both are classics.
Yeah.
Any tool or website you recommend, or you cannot live without?
Well, my own website, or a website that I like to go to?
Your website you like to go to.
I'm a big fan of the guys at ITR Economics. They do a good job.
Oh, yes.
So I've always followed their stuff. I read their book, Alpesh, Prosperity in the Age of Decline, back in 2014, right around when we were starting the build to rent. And they had fundamentals that they told us to look for. We looked for them, and they were dead right.
Oh, nice. Any advice for investors?
The best advice is do your homework and take action, and make sure you keep that yin-yang approach. Because if you just take action, and you're not assessing what you're doing, you could get into an issue. And if all you're doing is assessing, never taking action, you never get anywhere. and remember, it's a performance thing. It's not a numbers thing. You don't have to have 100 properties to retire off of properties, and that should be very encouraging. Again, it's about having quality properties, of better quality, less leverage, and better overall fundamentals.
Got it. How do you give back?
A couple of different ways. We're involved in a few different charities here in Jacksonville, one called Isaiah 17 that helps newly removed children going into foster care from their homes to have a safe and good place to live. We help support a good friend of ours, Guatemalan outreach program that helps orphan children in Guatemala. And I give a lot of I do some pro bono talks. I have a best-selling family book that actually did well on the Wall Street Journal list. And I give some talks, free family talks for those events as well.
That's awesome. How can my listeners reach out to you?
Yeah, the best thing, if you want to learn more about what we do, you can go to jjplaybook.com. jjplaybook.com is something that my wife and I designed about our whole journey of real estate over the last 24 years. And how we got into build to rent and the principles that we follow for our own investments. And it basically shows how did we get to over $40,000 a month in our own passive income, and how do we help other investors do that? So that's a great starting point. They can also look at Southern Impression Homes, our building company.
Thank you so much, Jim, for your time today.
Yeah, it was good to be here, Albesh. Appreciate the conversation.
Absolutely. Thank you.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!